How do you feel about credit in China at the moment?
We definitely have exposure in China, and it's more of a long-term view that China's economy is going to grow relatively fast over the next 10 years, particularly relative to developed markets. And if you look at the consumer as a percent of the overall economies still has a lot of upside there. So if you look at the consumer wealth growing there, those consumers will want to consume more, take more vacations, et cetera. So we definitely like the sector. The property sector has been under significant pressure. The government looks like it may come in and ease liquidity to the sector, mortgage availability, et cetera. So some of the higher quality property developers make sense. We mainly, though, like a lot of the services, the vacation, the travel and tourism sector. That's where we've been mainly focused on.
You talk about the consumer, and I think a lot of people were really surprised by the perceived strength of the US consumer despite the inflation numbers, right? The retail sales numbers really tell us that. Is that a trend that you could see more globally, that despite rising pressures, we are still seeing that consumer demand strength coming through?
Yes, definitely. If you look at the U.S. economy, we're going to grow this year real GDP 5.4%. We think next year in the U.S. will grow 4%. A lot of that is the consumer. The U.S. consumer is sitting on $2 trillion of excess savings. If you look at wages, they're growing at 3 to 5%, depending on what market you're looking at. But the labor market is actually very tight when you look at job openings, you look at the quit rates. Companies are also passing on higher prices. So the consumer looks very durable here. And if you look at what's happened, we've been spending a lot on goods. That's going to transition to services. So the real upside, we think, in 2022 is really these COVID-impacted sectors like airlines, lodging, gaming. All those sectors should recover. So look for the consumer to spend a lot on services, not just in the U.S., but globally next year.
Will we continue to see banks benefit from the reopening?
Banks definitely will benefit because banks are really a pure play on asset quality and very cyclical. Banks are a very cyclical trade. Really what you saw in the United States in particular was unprecedented fiscal and monetary policy support coming out of the crisis. We've run essentially 2 years of double-digit deficits in the United States. That all went to support the consumer. And so despite the fact that unemployment spiked, you saw asset quality hold up remarkably well. Banks have really benefited significantly from that. And now with interest rates rising and the potential for a steeper yield curve, banks will also benefit from those higher rates. Finally, as the economies have reopened, you've seen significant market underwriting activity help the banks, and that's been very clear in their earnings profile.
We've, of course, seen a lot of volatility in the treasury markets, but it seems credit has shrugged that off. We continue to see this barrage of investment-grade bond sales. Is this now the new way to go, or could we see a shift in trends?
Well, I think the net supply is actually going to go down a little bit next year because you have a lot of redemption activity. The low level of rates and the tighter spreads have no doubt encouraged a lot of issuance. But in general, the credit markets have been very resilient. And a lot of that has just been the underlying strength of the economy as well as corporate profitability. So you're looking at a very strong economy. In fact, inflation is elevated. It's likely going to stay elevated. We think that ultimately sets up for a more aggressive Fed. So overall, we have been reducing risk. We increased our credit exposure a lot about 1.5 years ago. We tilted into cyclicals. Right now, we are reducing a little bit of credit risk simply because we do think that with inflation risks elevated, the Fed will likely have to taper a little faster and potentially could raise rates as soon as the summer of next year.